iraní. Continuaremos actualizando y ampliando esa información, pero ahora vamos a hablar de análisis de mercado y de estrategia de inversión, y lo vamos a hacer en los próximos minutos con Edward Williams, multi-asset investment strategist en Alliance Bernstein. Good evening.
Hi there, how are you?
A strong labor market data last week has forced the US 10-year yield back toward 4%. What's your view on Fed policy and the US economy from here?
Well, I think the upside surprise in the non-farm payrolls last week is really a signal that the US economy remains in rude health. As we know, the labor market really kind of remains the most important driver of domestic consumption and thus the most important driver of US economic growth. And I think the debate now is really whether this data represents a re-acceleration in the labor market or whether it's more just simply kind of month-on-month volatility in data prints. So we would lean towards the latter. With these things, we think it makes sense to zoom out a little bit and consider more of a kind of a trend over a multi-month horizon. If you do that, over the past couple of years, we have seen meaningful kind of cooling in those kind of non-farm payroll data prints. And we think that's consistent with a labor market that is normalizing and coming into better balance. We think the Fed will take the same view, and we anticipate that they will make 2 more 25 basis point rate cuts to finish the year.
And Edward, what does this mean for positioning across your multi-asset portfolios?
So we still think that we are heading for a soft landing, i.e. a cyclical slowdown in growth, but kind of absent any kind of shock, we see no reason why this cycle ends in negative growth or recession. So in that type of environment, we think you want to own some equities, solid growth, falling inflation, and interest rate cuts is generally a backdrop that is supportive of risk assets. So we think it makes sense to kind of remain overweight there. Within equities, though, we prefer less kind of cyclical, higher quality businesses versus the more sort of cyclical parts of the market. We want to own companies with steady cash flow, profitability, and sales that can really kind of weather a more sort of benign economic environment. But then, as a kind of a multi-asset team, if you do have the scope to look outside of equities as well and include other asset classes, we think holding kind of high quality credit and some duration makes sense at the moment. So particularly kind of given where yields are, we think kind of a combination of that quality with quality equities as well gives you a really nice balance within a multi-asset portfolio.
And William, are stretched valuation in US equities a concern? Where else are you finding opportunities?
I think valuations are certainly one metric that we look at. And at an index level, they are expensive relative to history. And as you say, that's particularly pronounced in the United States. I think if we're thinking about things from a regional perspective, as you heard me mention before, we have a bias or a preference for quality companies and a preference for growth over value. And typically, the majority of those opportunities are found in the US. But however, we are kind of mindful that valuations in certain areas do look quite stretched. And we have looked to diversify some of that exposure somewhat over the last couple of months. So 2 areas that we like at the moment, min-vol stocks and dividend stocks, both of which continue to look a bit cheap versus the broader market, and typically perform better in periods of weaker or slower economic growth. We don't expect the economic environment to weaken materially, but if we do, those are 2 parts of the market that should offer some ballast. Now, I would say the other area where we do see some opportunity, both for kind of growth, but also for diversification away from developed markets, is within emerging markets. We've seen some strong momentum over the past couple of weeks, and we think when we get more clarity around kind of policy, there is further room to run for that part of the market as well.
Expand on that. How is your team thinking about emerging markets and China?
think generally there have been two quite big headwinds to emerging markets over the past couple of years. Higher rates in the US and developed markets, and then negative sentiment around China and the Chinese economy. And we think we've got some more clarity in the past month on both of those. Of course, the Fed, we saw them cut 50 basis points recently. And we've also seen the Chinese authorities come out and announce a range of stimulus measures really aimed at reigniting domestic consumption and the property market. Clearly in China, they are still battling with a range of very kind of structurally entrenched issues. Consumer confidence is close to post sort of GFC lows. Inflation is low to non-existent. And the property market, where we know such a high proportion of household wealth is tied up, remains in pretty sluggish territory. But generally, I think, as I mentioned before, we need to see more specifics around the plans for kind of fiscal support. But as a team, we see these measures as certainly a step in the right direction. And encouragingly, the market has done too. We have seen a pullback in the last couple of days, but even following this, there's been a very strong recovery in Chinese kind of equity assets, to the point where China is now actually ahead of the US on a year-to-date basis. And that's after being 20% plus behind just a couple of weeks ago.
And for finish, in this context, in the actual context, what's the biggest risk to markets as we move through fourth term?
So we see geopolitical tensions and the US election as the biggest drivers of risk over the next couple of months. I think in terms of the election, both the polls and the betting markets have the outcome within sort of error bands that make it almost impossible to predict. But clearly, uncertainty alone does have the potential to impede growth over the next kind of few months. I think there's already some evidence of this when we look at sluggish capex spending, and I think driven by some of this uncertainty around the outcome of the election. Historically, though, markets have generally been fairly well behaved during years where there are US elections. And our research tells us that over the long term, elections don't tend to have a meaningful impact on market returns. But what we do tend to see in most election cycles is an increase in market volatility in the lead up to November, which means we should expect and brace to see some increase in market volatility in the next few weeks. So following the election, if we do see kind of increased restriction on the flow of people or the flow of capital goods, I think certainly that has potential to be inflationary and or have a negative impact on growth. But I think in terms of how you're thinking about sort of positioning yourself for this increased volatility, we continue to really sort of advocate being diversified, advocate being flexible, and then focusing on quality, both within your equity exposure and your credit exposure. Then we think it also makes sense to extend the duration that you hold within your portfolio as well.
Williams, multi-asset investment strategist in Alliance Bernstein, thank you for joining in our show.
Thank you.